Glyn. Let's reflect on a pretty extraordinary January 2015.
Absolutely extraordinary month. We've been through some extraordinary periods in the last 5 or 6 years, but this must rank right up there as one of the most extraordinary months. And the news was dominated almost entirely by Europe. Three really big sort of outsized events, with all of which have big implications, I think. First of all, the Swiss central bank, the Swiss National Bank, which has pegged the Swiss franc against the euro since 2011, just instantly dropped the peg, to everybody's surprise. Well, of course, pegs can only go with the surprise. You can't forewarn people. Swiss franc rose immediately by 30%. Then the next big event was the ECB, this quantitative easing that we've been talking about, that Draghi's been trying to get through for a long time now. Finally, he got it approved and actually surprised the markets pleasantly with the size of the buying of assets over the next couple of years. Huge amounts of money, over €1 trillion of assets they're going to buy. And then right towards the end of the month, the third big event in Europe was the Greek election, which arguably was unnecessary but happened anyway. And as the polls were indicating, and much to the concern of the sort of Europhile elite, this far-left Syriza party didn't quite get a complete majority, but was able to form a government with another anti-austerity party, and a government now in Greece with very strong rhetoric calling for an end to austerity, throwing out the bailout terms, but wanting to stay in the euro, a combination of events which is economically and practically almost impossible to achieve. So it's been a most extraordinary month, and markets have reacted in a pretty extraordinary way to it all.
Well, let's move straight to the markets. Obviously, with Europe at the sort of epicenter of the news flow, perhaps unsurprising to see the euro weaken off.
Well, not a surprise at all. It's continuing this weakness. It had a big fall in the month, particularly post the ECB announcement, and then worries about whether Greece was going to cause a big upset by, for instance, coming out of the euro. Then what happens? What's the impact on other countries in peripheral Europe? In fact, the euro fell by about 7% against the dollar and nearly 10% against the yen. Really, really big falls. And the other incredible thing that we've seen happening is bond yields, which have already been falling throughout 2014 in Europe, continue to fall. In fact, fell quite sharply. And I think one of the interesting things is that despite the news on Greece, which was clearly very negative for Greece itself, and bond yields spiked upwards there, it had no impact on any other market in Europe. The peripheral European bond market, Spain, Italy, actually yields continue to fall. And we now face a situation in Europe, right across Europe now, where we've got interest rates on government bonds at all-time lows, multi-century lows. We've got, I think it's now 7 or 8 European countries with negative interest rates on 5-year bonds, and there's about 10 with negative interest rates on 2-year bonds. Switzerland is able to borrow money out as far as 13 years along the curve with negative interest rates. In other words, if you lend to the Swiss government today, and lots of people are still doing it, you get less money back than you've given them after 13 years. And it is the most extraordinary thing. And in fact, just finishing off on this extraordinary month in bond markets, for the first time ever, we've seen a corporate in the form of Nestlé, admittedly a very strong corporate, have negative interest rates on its corporate bonds. Quite extraordinary. So against that background, strong rises in bond markets, that interestingly spilled over into other bond markets outside Europe. So yields fell on US Treasuries, on UK gilts. The UK gilt market had a very strong month. And all of this, I guess, supported as well by this deflationary environment that we are in, and the fall in the oil price that we've seen now over the past 6 or 7 months is now feeding through to headline rates of inflation. Europe has got a negative inflation rate of 0.6%. These are extraordinary numbers.
We've seen, in fact, more central bank activity, probably a reaction to this fall in the oil price and deflationary moves.
Absolutely. In fact, it's been one of the most active months for central bank policy easing since this crisis started. We've had 10 really quite significant, I wouldn't quite describe them all as major, but quite a number of the major central banks easing policy, either the ECB with quantitative easing, the Swiss National Bank cutting rates as part of its program to try and keep the Swiss franc down, failing to do so, of course. The People's Bank of China has eased reserve requirements, continuing its program of monetary easing in the face of actually quite a sharp slowdown now in economic activity. So you've got this easing program going on pretty much around the world. It's pretty clear that the UK is not going to raise interest rates this year, despite the fact the UK economy has come out with the strongest growth figures amongst the developed nations for 2014. There's no signs of inflation here in the UK. And you've got this new terminology being used by the Fed talking about patience in its approach towards raising interest rates. So there's a new language there suggesting that rates aren't going to go up too soon. So you've got all of that, and you've still got the ECB and the Bank of Japan pumping just huge amounts of money. The ECB is buying assets at the rate of $60 billion a month, and they've committed to do that until September of next year. That's over €1 trillion they're going to be buying. We know for sure the Bank of Japan is going to carry on at buying about $50 billion a month. So you've actually got bigger quantitative easing in terms of central banks buying assets than we've had throughout this crisis. So it is a huge support to asset prices. There's no question about this.
And against this incredibly choppy background, it's unsurprising again to see equity have a pretty bad start of the month. It did rally into the end of the month though.
It did. Equity started badly, and I think the fall in oil prices, which we'd noted that over the last couple of months, has actually slightly unnerved investors. It's hit energy shares, obviously. It's worried people about growth in the economy. It continued to be a worry in the first half of the month. The oil price fell to a low of about $45 a barrel. This news coming out of the ECB was a very positive thing for European assets, and in fact we saw a very sharp rally in European equity prices, led by Germany. And incidentally, Germany was up 10% in the month, and Germany is a tremendous beneficiary of what is happening here. It's got a currency which is far too weak for the strength of its economy, and the news coming out of Germany is beginning to get better. Retail sales are embedded. In fact, retail sales across the Eurozone have picked up a little bit, and leading indicators are actually looking more positive. So as we see the news on the economy begin to tick up, which we have done towards the end of the month, we've had a really very sharp rally. And I think one of the most notable things we've seen in this rally in equity markets is that the US has underperformed. First time in a long time. As we know, the US had a big outperformance last year against all other markets. This year, it's actually underperforming. It actually fell 3% in January when the MSCI Europe index was up nearly 8%. Now, in dollar terms, it wasn't up by as much as that, because of the fall in the euro versus the dollar. But nevertheless, we're seeing a turn here, and I think we're going to see more of that as the year goes on. I think that some of these markets that underperformed a lot last year are going to do better versus the US. And the news coming out of the US on the economy remains good, but it's quite clear that corporate profits are suffering from a strong dollar. Translation effect, tougher to sell into overseas markets, and we've seen some actually somewhat disappointing news on corporate earnings through this season so far. So I think we will see a turn in this relative performance of the US underperforming now versus other markets.
If we look forward then to the coming months, I suppose Greece is going to continue to hog headlines, isn't it?
I'm afraid it will. Yes, Greece will be the dominant feature, certainly through the month of February. There's a key date at the end of February. February the 28th is the date when the current loans program from what's called the Troika, the European Commission, the ECB and IMF requires renegotiation. And the new government, this new far left government, is in negotiations. I think it's probably fair to say that there's been a pretty big standoff. The Troika is making it very clear there's very little ground, that, if any, that can be given. And if indeed, just today, the ECB has noted that it will no longer accept Greek sovereign debt as collateral for lending to Greek banks. It's a symbolic move as much as anything else, but it indicates that the ECB regards Greece as out of a bailout program. So the new government in Greece is no longer talking about a write-down of debt, but a restructuring of debt. These negotiations are going to continue. They're going to worry markets on a day-to-day basis. The worst case, of course, is that the negotiations completely break down and either the Greek banking system gets into, putting it bluntly, a hell of a mess, can't get funding, or in the very worst case, Greece comes out of the euro. That's not what anybody wants, and I think what will actually happen is that it will be the usual sort of European muddling through. We'll get there, but I think it will cause a bit of nervousness in the next few weeks and possibly beyond that. But the one thing I would emphasize is this: Greece is not the threat that it was 3 or 4 years ago when this problem first blew up. Nearly all of Greek debt, which is still a big number incidentally, but it's nearly all Greek debt is owned by the Troika. There's very little private sector exposure. Banks have cut their exposure. So assuming that Greece maintains its position in the euro and there is this muddling through, I think that markets will actually steady and improve quite a bit as the year goes on. As I say, a few bumps on the way, but there's this tremendous tailwind of the benefit to the consumer for this big drop in the oil price, and we are beginning to see that coming through into consumer spending. We'll continue to do so. So dips in markets, I think, are an opportunity to add to positions, as I say, particularly in the non-US markets through the course of the next few weeks.
So plenty to keep us busy, but overall a sort of positive way to end. So thank you for that, Glyn.